Hey, I just heard about a new loan program you guys are going to want to learn about. 1% down. And the best part is, based on the parameters of the program, it's going to cost you less to get into a home that you're going to own compared to an average comparable rental in Colorado Springs. I'm going to speak with Chad Engler of American Liberty Mortgage about his 1% plus program. Plus meaning that the other 2% that makes up the portion of the down payment is a gift to you. Also, we're going to go into a side-by-side comparison with an FHA loan versus a 1% plus program that Chad is offering. Finally, Chad is a real person. I've met him. I've done business with him for years. He's located right here in Colorado Springs. So this is not some crazy internet program where you'll never speak to anybody again and your loan and your down payment all disappears. This is real. So I'm excited about this. Stay tuned to the very end when we break it all down. Let's get started.
Thank you for having me on, Eric. I appreciate your help. I know we've worked together on a couple of personal deals as well as helped some clients out in the past.
Okay, so the elephant in the room, it's 1% down. How does that work when I know that for most FHA loans, it's 3.5% down?
Right. So what this program is it's a program from Rocket Mortgage, where Rocket Mortgage is actually going to front our buyer that 2% and ultimately give them a 3% down payment in full. However, that 2% loan, it's not a loan, it's not a grant, and it doesn't have to be paid back. So this is essentially free equity that Rocket Mortgage is providing to these new home buyers. And you can actually own one other property as well. You don't have to necessarily be a first-time home buyer.
They can use this as a second-time purchase. They do not have to be a first-time home buyer.
Correct.
And the individual that is getting this loan, unlike say Chaffa, this is not a second mortgage. This is not something where there is a bump in the interest rate to cover this. Rocket Mortgage is fronting the additional down payment. So it's basically free money on top of whatever they buy their home for.
Correct.
Chad, this loan program makes me think right away that with 1% down, when you talk about say an average, $315,000 home in Colorado Springs, you've got a down payment of, $3,150. There's obviously closing costs on top of that. But if someone were to go out and rent a home in that same price range, they'd be looking at potentially first month's, last month's, and a security deposit of around $5,000 to $5,500, depending on the rental rate that they got.
So this is where that free equity is going to come in. So with the 2% that Rocket Mortgage is going to be covering, that's going to be just over $6,250 for this particular situation. And like you said, with a first month, last month, and a security deposit, you're actually going to be higher than that. Like you said, we do have some closing costs that are going to be associated with the loan. And that's something where, again, we're going to work with our buyers and our sellers to maybe see if we can get some concessions.
With every loan, there are scenarios that pop up that are specific to the borrower, but two big program overlays. There is a loan limit and there is an income limit. Talk to me about those.
So with this particular property, it is designed to get folks into a loan that would be no greater than $350,000.
That's a loan amount, not a purchase amount.
Correct, loan amount. So in reality, with our closing costs and your down payment, you're looking at about a purchase price of about $360,000.
Okay.
I know that when we were looking in El Paso County, we were both surprised. There's quite a number of properties that are going to fall into that price range, and that's going to be one of our big items up front. The second item, like you said, is an income limit. So for El Paso County, for a single borrower, it's just over $81,000. And if we have two borrowers on the loan, it's just under $93,000.
And that income limit works for both self-employed and employed, correct?
Absolutely.
And the lowest FICO credit score that this program allows?
Yep. So the program does allow us to go down to 620. However, we are going to need to have some compensating factors at that particular credit score. In my simulators, I used a 680 credit score to run these interest rates as far as the 6.99. And that is going to give us a strong DU approve eligible.
Let's talk about two other major concepts here with this loan program, and then we'll wrap this up so that we can keep this video nice and brief for everyone who's watching. Free money is obviously great, and who doesn't love free money? The equity that this loan program builds into your home, say as compared to what we call the gold standard of loans, which is the VA loan with no money down, you actually get equity into this deal. Now, while it's not true no money down, it's damn near close. So I think that gives this loan a real edge. Any, just kind of personal opinion thoughts on that?
I love the VA product, and for our veterans, that can be a really great way to go. But when you are working with the VA, you are actually financing your closing costs as well as potentially your funding fee. And what is happening at that point is you're actually upside down on your mortgage versus this particular program that we're talking about, where you're actually going to be walking in with 3% equity in the property. With a VA loan, between funding fee and closing costs, you're probably looking at being anywhere from 2.5% to 3.5% upside down on your mortgage. If you just made regular monthly payments, it's going to take you over 3 years to get, to 100% loan to value versus, let's say, 103%.
Yeah. And again, folks, we're not trying to pull the wool over anybody's eyes here. There is a loan limit of $350,000, and obviously the VA does not have a loan limit. And that was something that was removed a couple of years ago for all of you out there who are still fixated on the idea that El Paso County has loan limits. It's very much determined now by debt to income. So let's run through this loan scenario that you were kind enough to illustrate. And folks, what I did was I looked underneath 315,000 in El Paso County, included condos, townhomes, and single family homes. And again, this is all of El Paso County. And I averaged the amount or the type of homes that were there and found that they were about $315,000 on average, below 350. So you kind of have to do some mental gymnastics, carry the one, think about the two, and you end up with that average. And I said, okay, Chad, run a loan scenario based on 315,000 against FHA. And you'll notice in this chart that the loan amount for FHA is much lower. And you're thinking, what gives? Why aren't we doing apples to apples? And that's because, remember, FHA has a 3.5% down payment. So we had to go lower in the loan amount. But I want to have Chad explain a couple of really important points, the way that mortgage brokers analyze loans for their clients. So Chad, talk to me about the One Plus versus FHA.
In our graph here, the first thing that you're going to see, like you said, is that the loan amount is quite a bit different. It's roughly about $8,000 lower. Our 1% down, you're looking at $3,500. FHA is at over $11,000. The interest rates. So I used a 6.99 for the One Plus, and then I used the 6.875 for FHA, which is today's interest rate with 2 points. So that's additional funds that you're going to have to bring to closing of just over $6,000. As we now, move down to monthly principal and interest payments, our payment is going to be a little bit higher on the One Plus program because, again, our loan amount is $311,000 versus $303,000. So that puts your monthly principal and interest payment at $2,070 versus FHA at $1,997.
Which is
so you're looking
$73 difference.
$73 difference. And we're going to come back to that when we look ultimately at the cash to close, right? So with the One Plus program, you've got your $3,500, which is your 1% down. Then you've got roughly $4,000 in closing costs, which we're going to have with FHA as well. but that means that your total cash to close is going to be $7,500 with the One Plus program.
In the market right now, a $315,000 home, condo, townhome, single family, I'm typically able to negotiate anywhere between $5,000 and $6,000 in concessions from the seller. So we can use that to offset your cash to close requirement on either loan scenario.
Absolutely. Whereas with the FHA loan, you're looking at not only your 3% down, which is just over $11,000. You've got your 2 discount points at just over $6,000, plus your closing costs. So with an FHA loan, you're looking at needing $26,000 cash to close versus $7,500 with the One Plus program. So if we actually take that difference in the monthly payment and the difference in your cash to close, so your monthly payment is $73 more with the One Plus program. However, your cash to close is $19,000 more with FHA. So if I take that $19,000 and I divide that by $73, that takes you 260 months to recoup that cost. And for easy math, that's 21 years and 7 months to recoup that cost. This program really allows you to get into a home with much less down, and it's not going to cost you that much more per month in reality.
I like the loan, I like the product, and obviously I think that you are a very great and very competent lender, and I know that you can help a lot of people with this type of loan. So we just got done talking with Chad Engler on the topic of the 1% plus loan, he's calling it. Remember, this is a program that he's partnering up with Rocket Mortgage, and they're giving you 2% towards the down payment, and it's a conventional loan. We went through that spreadsheet there where he talked about the various costs of the 2 programs, and I just want to highlight some few drawbacks and then definitely some advantages. First off, there's an income limit. You can't make more than $81,900 for individuals, and for 2 people on the loan, you can't be more than $93,600. So if you're a high income earner, this program won't be for you. Also, there's a strict loan limit of $350,000. So we're not going shopping for $400,000 homes. Ideally, this home loan works for people with 680 FICO and above. He can go down to 620, but as he told you on the video and in conversations with me later, 620 is really difficult because of the mitigating factors, credit supplements that they have to put you through, bill paying history, probably seeing some extra reserves in your savings account. So it's doable, but just understand there's some extra legwork and a little more loan pain to go along with it. Let's go on to the positives of this program. There's way less out-of-pocket costs compared to an FHA style loan. The gift of 2% equity is awesome. Who doesn't love free money? Compared to some of the other programs that are out there where there's gifts, there's usually something on the back end that kind of infiltrates that number and makes it not quite as appealing. I'm thinking about like the El Paso Turnkey or Chaffa, where the rate is bumped up maybe a half to 1 to 2 points higher. And so that entity is making back that gift money. Each loan has its own strengths and weaknesses, but I just want to highlight this 1%er for right now. So as compared to those other loan programs, there's some real strengths here. Let's keep in mind that the difference in the monthly payment savings, lenders love to talk about this. They talk about it in terms of cost to or time to recapture that out-of-pocket cost. So we highlighted the difference in the out-of-pocket expense being roughly $19,000. And when you divide that by the monthly payment savings of about $73 when you compare FHA versus the 1%, you're looking at a time to recapture of about 260 months, or better yet, 21 years and 7 months. Finally, the last biggest advantage with this loan program is something that I mentioned back in the introduction of this video, where I talked about the cost to get into a home that you're going to own compared to a rental. Let's take that average rental rate at this price range of about $1,800 a month. And when you figure that a landlord is going to ask you for first month's, last month's, and a security deposit, that's $5,400. If I can get you between $5,000 and $6,000 in concessions on a $300,000 to $350,000 property, we can use that to offset your cash to close, and all you'll really be responsible for is that 1% down payment. Now, this doesn't include your appraisal and your inspection fee, but if I can beat that $5,400 cash required to get into a rental, homeownership begins to feel a little bit more financially smart compared to a rental right now. There's a lot of conversation going on in the news right now that it's cheaper to rent than it is to buy. And if you reference my last video that I did about the cost to live in Colorado Springs, that is true on a monthly basis. But if you want to own a home and you want to have equity and you want to have the ability to paint the walls your color, then this is a great loan program for you. I really encourage you to reach out to me to learn a little bit more about it and discuss the options that may be right for you. I look forward to speaking with you soon. Thanks again for watching the video.